I bet you didn't know how we transitioned from barter to bullion. For millennia, humanity relied on barter. Goods and services were exchanged directly. This system was inefficient. It relied on the coincidence of wants. Gradually, societies converged on a solution money. Early forms included shells, beads, and livestock. These lacked durability and portability. Gold and silver emerged as superior forms of money. They are rare, durable, and divisible. These properties made them ideal mediums of exchange. Societies transitioned from barter to precious metal-based economies. This marked a pivotal moment in economic history. The use of gold and silver coins flourished. Empires rose and fell, their currencies reflecting their power. The Roman aureus, the Byzantine solidus, and the Spanish gold doubloon are examples. These coins facilitated trade and empire building. They standardized values across vast distances. However, carrying large quantities of gold was impractical and risky. Paper money emerged as a lightweight alternative. Initially, it represented claims on actual gold held by banks. This innovation paved the way for the development of modern banking systems. The 19th century witnessed the rise of the gold standard. Nations pegged their currencies to a fixed quantity of gold. This system promised stability and predictability. It facilitated international trade and investment. Under the gold standard, exchange rates were fixed. This eliminated currency risk for businesses. It fostered confidence in international transactions. The gold standard is often associated with a period of economic growth and prosperity. However, the gold standard had its critics. It limited the ability of governments to manage their economies. Governments could not print money freely to stimulate growth or combat recessions. This rigidity led to deflationary pressures. The gold standard also relied on the responsible management of gold reserves. Countries that depleted their reserves faced currency crises. This could undermine confidence in the entire system. The outbreak of World War I shattered the fragile stability of the gold standard. World War I forced nations to abandon the gold standard. Governments needed to finance wartime expenditures. They resorted to printing money, severing the link between their currencies and gold. This marked the beginning of the fiat money system. Fiat money derives its value from government decree, not a physical commodity. This gives governments greater control over their monetary policies. They can adjust interest rates and money supply to influence economic activity. This flexibility is a key advantage of fiat money. After the war, attempts to return to the gold standard proved unsustainable. The Great Depression exposed the limitations of the gold standard's rigidity. Governments needed more flexibility to address the economic crisis. In 1971, US President Richard Nixon severed the dollar's final link to gold. This marked the definitive end of the gold standard era. The world transitioned to a system of floating exchange rates. Fiat currencies became the dominant form of money globally. The collapse of the gold standard ushered in an era of unprecedented economic experimentation. Governments, armed with the tools of fiat currency, explored various monetary policies. Some proved successful, others disastrous. One significant consequence of the fiat system is the rise of sovereign debt. Governments, no longer constrained by limited gold reserves, can borrow heavily. This can lead to unsustainable debt levels, as seen in recent sovereign debt crises. Despite its potential pitfalls, the fiat system offers undeniable advantages. It provides flexibility to manage economic cycles. Governments can use monetary policy to stimulate growth, control inflation, and mitigate recessions. However, the effectiveness of these interventions is debatable. Critics argue that excessive government intervention can distort markets and create unintended consequences. The debate over the optimal role of government in a fiat system remains a contentious issue. Despite its dethronement as the dominant monetary system, gold retains a unique allure. It is seen as a safe haven asset, particularly during times of economic uncertainty. Investors flock to gold when traditional assets like stocks and bonds decline. Gold's value is not directly tied to any government or economy, making it a hedge against inflation and currency devaluation. During periods of geopolitical instability, gold is seen as a store of value that transcends national borders. Central banks around the world hold significant gold reserves, highlighting gold's enduring importance in the global financial system. While no longer a primary currency, gold serves as a reserve asset and a symbol of financial stability. The demand for gold is driven by a complex interplay of factors. Economic uncertainty, geopolitical risks, inflation expectations, and investor sentiment all contribute to gold's price fluctuations. Understanding these drivers is crucial for navigating the gold market. The debate between gold and fiat currencies is centuries old, reflecting fundamental differences in economic philosophy. Proponents of gold emphasize its stability, scarcity, and historical track record. On the other hand, fiat supporters highlight its flexibility, adaptability, and suitability for modern economies. Gold, as a physical asset, is inherently limited in supply, appealing to those who view inflation as a monetary phenomenon. They argue that fiat currencies, easily manipulated by governments, are prone to inflationary spirals. Fiat currencies, however, allow for greater adaptability. Governments can adjust monetary policy to address evolving economic conditions. This flexibility, proponents argue, is essential for managing complex modern economies. The debate between gold and fiat is not merely theoretical. It has practical implications for investors, policymakers, and citizens alike. Understanding the strengths and weaknesses of each system is crucial for making informed decisions in a rapidly changing world. Contemporary economists hold diverse views on the gold versus fiat debate. Some advocate a return to some form of gold standard, citing its historical stability and inherent discipline. They argue that fiat currencies have led to excessive debt and reckless monetary policies. Others maintain that the gold standard is antiquated and impractical for modern economies. They argue that fiat currencies, despite their flaws, offer the flexibility needed to manage complex global financial systems. Central bankers tasked with maintaining price stability and economic growth face a delicate balancing act. They must navigate the challenges of fiat currencies while acknowledging the historical lessons of the gold standard. The debate over the future of money is not limited to gold and fiat. Cryptocurrencies, like Bitcoin, have emerged as potential challenges to the established order. Their decentralized nature and potential to disrupt traditional financial systems have sparked intense interest and speculation. The rise of cryptocurrencies adds a new dimension to the age-old debate over money. Bitcoin, the first and most well-known cryptocurrency, operates on a decentralized blockchain network. This eliminates the need for central banks or intermediaries. Proponents of cryptocurrencies argue that they offer a more transparent, secure, and efficient alternative to traditional currencies. They envision a future where cryptocurrencies revolutionize payments, finance, and even governance. However, cryptocurrencies also face significant challenges. Their value is highly volatile, making them unsuitable for everyday transactions. Regulatory uncertainty and concerns about security breaches pose significant obstacles to their widespread adoption. The future of money is likely to be a dynamic mix of traditional and emerging forms. Fiat currencies, backed by central banks, will likely remain dominant in the near term. However, cryptocurrencies and other innovations will continue to challenge the status quo, potentially reshaping the financial landscape in the decades to come. The debate between gold and fiat currencies is unlikely to be settled definitively. Each system has its strengths and weaknesses, reflecting different economic philosophies and historical contexts. Understanding these nuances is crucial for navigating the complexities of the monetary system. The future of money is likely to be characterized by ongoing innovation and evolution. New technologies such as cryptocurrencies and digital currencies issued by central banks will continue to emerge. These innovations have the potential to transform how we think about and interact with money. Ultimately, the most important factor in determining the success of any monetary system is trust. Whether it is backed by gold, government decree, or decentralized technology, money relies on the confidence of those who use it. Maintaining that trust is paramount for economic stability and prosperity.